While the China-US trade spat simmers, the source of angst among dealers has moved to Rome after the populist government passed a purse-busting budget last week that drew a rebuke from Brussels and warnings to abide by EU rules on public spending. Asian markets slumped at close as the Nikkei dipped 0.7% to 24,110, while the Hang Seng edged down 0.1% to 27,091. The Shanghai Composite remains closed for public holiday. US stocks tumbled again on Wednesday, confirming a correction for the Nasdaq and erasing the Dow and S&P 500's gains for the year, as disappointing forecasts from chip makers and weak home sales data fueled worries about economic and profit growth. The Dow Jones Industrial Average fell 2.41%, the S&P 500 lost 3.08%, and the Nasdaq Composite dropped 4.43%. Let's take a look at how European and local markets are performing. Chantal Marks from FNB Wealth and Investment joins me now from the JSE. Thanks so much for your time, Chantal. Let's go back to yesterday and that medium-term budget policy statement. What's the market reaction to that yesterday and continuing into today?
Yeah, I mean, so it was basically it was a bit worse than expected in terms of the budget deficit, as well as absolute debt levels expected for this year, next year, and then over the medium-term expenditure framework, which is usually around three years. So bond yields spiked up and reacted negatively. The rand reacted negatively as well. Equity markets were quite interesting. Initially, we saw a slight bounce, particularly in consumer stocks, but then that kind of abated towards the end of the day. Of course, a higher expenditure budget and the fact that the minister guided for, well, he didn't guide for any tax increases next year, would have been positive for consumers, and that's probably why we saw that type of reaction.
Mm-hmm. Let's go to international market. We saw that sell-off on Wall Street yesterday, erasing gains from 2018. What's happening there?
Yeah, I mean, so markets are extremely volatile at the moment and very sentiment-driven at present. It's less about the fundamentals at this point in time and more about news flow, kind of market jitters coming to the fore in terms of what expectations are for interest rate hikes in the US as well as elsewhere in the world. Higher interest rates generally are not good for equity markets. And then there was, I think, out of the entire basket of earnings that we've seen over the last week and a half, we've probably seen a handful of misses, but one of them came through yesterday, and as a result, the market was sold off. A little bit of investor jitters around whether or not sustained earnings growth in the US is possible, and sustained growth overall.
Mm-hmm. We also saw Asian markets following that US trend downwards. Is that related to what's happening on Wall Street?
Yeah, absolutely. It seemed to kind of just follow on from negative sentiment in Wall Street. Of course, today, actually, the markets look a little bit better. Initially, we also opened quite sharply in the red, but some positivity sneaking into the UK and European markets, it seems, and therefore transferring over to us as well. And then futures markets in the US also guiding towards a higher open today. We have some very important earnings releases out later today, some big technology stocks due to come out with third quarter results, Alphabet, the Google parent company, and Twitter among them. So perhaps the market not as negative today as it was yesterday and overnight.
Let's come back to South Africa and start taking a look at some company news. We'll start with AB InBev, down over 10%, it looks like. What's happening there?
Yeah, I mean, so as expected, AB InBev announced today that they will be rebasing their dividend. Basically, what it means is they're going to cut their dividend in half. And the reason why they are doing it is because they have an exceptionally high debt burden after they acquired SAB Miller a few years back. So they basically want to use the money that's generated within the company to pay down debt instead of paying a dividend to shareholders. longer term, that's probably the right thing to do. But shorter term, investors have become a little bit spooked, even though there were rumors about this for a while. Another factor would be the fact that they had a slight miss on an operating profit level. It's about a 4% miss, but with markets being so jittery as they are, and with sentiment being so easily swayed, the reaction was, it seems like an overreaction, but that's what the market does at the moment.
So let's continue speaking about sentiment. We saw earlier in the week a furor over Truworths, finding out that their head in their companies is very untransformed. It's a mostly white male leadership in Truworths. People coming out and saying the company is racist and untransformed. Is that affecting their stock price? We're seeing it's down about 1.68%, or is that just a normal fluctuation on the Truworths share?
So it could have an impact, because that is the latest kind of news that came out of Truworths. That came out late yesterday, I think. And yesterday morning, they released sales numbers that were actually a little bit worse than expected, and it seemed as if they weren't going to meet market expectations for the full year from a top line growth perspective. But certainly, the transformation of their board and leadership, I think, should be an imperative. One of the things that we've noticed in Truworths relative to some of the other retailers are that they are consistently missing on fashion, and they seem to be following an old recipe that has kind of expired, or seems to be expiring now. If you look at management both at Foschini Group and at Mr. Price and at Woolworths, it's a lot more transformed, it's a lot more diverse, and as a result, and it's actually scientifically proven, they're making better decisions.
Chantel Marks from FNB, thanks so much for your time on SABC News, giving us a look at some company news and what's happening on the markets locally and internationally. I'll have more business news for you after the break. Do stay with us.